Hi, it's Eric Nuttall of the Ninepoint Energy Strategies with this weekly update. I thought I would spend a few minutes time going through how we are positioned today. There's been a shift in terms of structure of our main fund over the past couple of months. So I wanted to go through the reasons, what's been changing, what we're seeing, and why we are slightly more bearish on oil over the medium term, I would say. So this is about call it a 9-month call. We'll go through the logic to that, why we've increased our weighting towards natural gas, and why, after many years of being bearish on natural gas, why we're now bullish, and that's where we're positioned. Coming into the year, we had thought that oil would trade at roughly a $70 price. We've reduced that by at least 10, likely $15. What has changed has been two things. One is the outlook for demand growth this year has meaningfully fallen on the back of Trump being, I would say, a little more hawkish in terms of actual enforcement of tariffs, the antagonistic stance that he's had with China, and the expectation, I would say, that there's going to be about a 10% baseline tariff across the board, not just on China, but on all countries. We're seeing a bit of a slowdown in terms of demand growth from that. Q1 was very strong, depending on the source, anywhere from 1.2 to 1.7 million barrels per day year over year. But I think we're starting to see a bit of a moderation in leading edge data that we have access to. That's also being expressed in oil inventories globally, where they have grown more than what we would have thought from January to the most recent week. So the first 19 weeks, we're up roughly 170 million barrels. Part of that is oil and water. We think that that is sanctioned barrels increasing, just perhaps not being able to find a home, but we're seeing onshore builds as well. And so the market has loosened. The second thing that has changed has been the I would call it a pivot in terms of policy from the members of a voluntary deal within OPEC. They had originally intended to return a headline roughly 2.2 million barrels per day over an 18-month time period. What we've seen is two consecutive actions to accelerate and basically get a 3-for-1 return of those barrels in April and May. Now we've got a meeting June 1st where the suspicion is they will once again have another accelerated return of those barrels. We've spoken in the past, okay, what is the motivation for that? We don't think it's some grand deal with the United States between Saudi. We do think it's just running out of patience, where we've seen chronic cheating from Kazakhstan and Iraq. Iraqi current compliance has improved, not quite the compensation barrels yet. Kazakhstan, we see no signs of improvement whatsoever. And so we just don't know how the key leadership within that deal, that voluntary deal, keep face if they don't continue to send a message that they will no longer put up with a severe lack of compliance from Kazakhstan. And so it's really our outlook for the next 6 to 9 months that has degraded. What we see are global oil inventories meaningfully starting to increase in the next couple of months. We do have a couple seasonally stronger demand, heading into the summertime for the U.S. driving season. Yeah, parts of the Middle East, they burn more oil for cooling demand because it gets like incredibly hot, as you can imagine. But once we get out of the summertime period and heading into the fall, that's where we would expect to see meaningful inventory builds. And so our view on oil prices will be trading at roughly a $50 to $60 range for the next 9 months, 9 to 12 months. We retain some flexibility in that view. The logic to that is if demand growth continues to falter a little, if the voluntary members of the OPEC deal continue to add barrels and even at an accelerated rate, then the balancing factor in the market needs to be short cycle supply, which is namely U.S. shale. We've spoken in the past about how we think the U.S. Shale has reached its twilight, meaning the best days and years of growth are far behind us. We know 2024 was the weakest rate of growth since the rise of U.S. shale, excluding COVID. But what we think now is the price needs to result in not just flat production, but also production declines. We've seen commentary from the likes of Diamondback speaking to how they're moderating growth, how they need $70 to $75 before they start to grow. ConocoPhillips this past week said that, well, at 60, production is just going to flatline. We're a little more bullish than that. We think production will fall anywhere from 3 to 500,000 barrels per day, exit to exit at 60, and at 50, you're losing about a million. And so depending on the severity of the deceleration in demand growth, we need to lose a couple 100,000 to a million over the next, call it 9 months to a year. In 6 months, 9 months time, whatever time frame, I think the market has become a lot more bullish. The reason for that is that we think that U.S. shale will be in structural decline or structural plateau, depending on the oil price, the world will have lost that most meaningful source of near-term supply growth, while there are areas like Guyana, Canada to a lesser extent, Brazil again to an even lesser extent. What we see is many basins in the world being mature and the Twilight of U.S. shale resulting in non-OPEC supply essentially peaking in a couple of years' time. We also think the demand for oil is going to grow much longer and stronger than consensus believes. And while OPEC members, Saudi as well, has been cutting back on growing their future capacity, we think that we'll once again return to a structural bull market for oil. But again, we've got some wood to chop. We think there's a bit of a storm that we need to get through from oil. And so we've reduced over the past, call it 4 months, our oil weight down to about 25%, 24% today. We have three key names. One is undergoing a hostile bid. We've spoken to that on BNN earlier this week. Another is also a mid-cap oil sands producer who we think their reserves, their deep inventory will become very strategic over time. And then our last holding is a Clearwater player where we think they can sustain production, their dividend down to $42. What is more exciting to us in the short and medium term is natural gas. And it's been a product that we've been quite bearish on for many, many years. And I think directionally our call has been quite good. The reason why we've been bearish is that too much of the investment thesis has really revolved around weather. And anytime, balances were good and we're heading into either summer or winter, Mother Nature would come and disrupt the investment thesis, providing either a cold summer or a warm winter and negating, heating/cooling demand. What has changed over the past year to 2 years is really the meaningful increase in structural demand coming from liquefied natural gas, LNG, from the Gulf Coast. The U.S. is exporting 16 BCF a day now versus production of about 103, 104 BCF a day. So call it 15% of their market is exported. And that 16 BCF a day is going to grow to about 26 to 28 BCF a day by the end of the decade. And so that's a very, very meaningful increase in demand. Secondly, we have in Canada, LNG Canada should be ramping in about a month's time, increasing to about 2.1 BCF a day of feed gas, which net exports of about 1.8 once you account for shrinkage. So we'll round it off and call it 2. So that 2 BCF a day in 2025 could increase to about 6 to 7 BCF a day by the early 2030s. And so that's a really positive improvement to the outlook for Canadian gas producers, because we've always been the guys at the end of the pipe, meaning we've been shipping our gas to the US and we get the weakest pricing and the widest differential. LNG Canada should shrink that pricing differential, which today sits about $2 per MCF, down to about $1.10 to $1.30. So that's a very, very meaningful improvement in terms of margin and free cash flow from natural gas companies. When we look at supply, there's a few positive dynamics. Firstly, the meaningful supply needs to come from higher cost basins, mainly the Haynesville. Private operators have been saying that their required supply cost is about $5 per MCF. Lower cost basins like the Marcellus, Canada, we think grows at $4. So we think we're going to be in about a $4 to $5 price band over the next several years. Secondly, with the Twilight of U.S. shale and lack of meaningful oil production growth and likely declines over the next year and potentially longer, that also means that there'll be a lot less associated gas growth coming from mainly the Permian. And so what we've seen this week, Enterprise Products said that they still expect growth. They've been a little more bullish than others. But as production starts to flatline, associated gas growth, there's still some growth, but effectively gets cut in half. And so the supply dynamics we think are again suggestive about a $4 to $5 band. When we look at natural gas equities, at a $4 price, we see average free cash flow yields of about 10%. At $5, we see roughly 16%. And that's on average. We have some holdings that are more attractive than that. And it's similar to our investment thesis in the oil sands, where you're getting decades worth of stay flat inventory. Many shale companies, both in the US, for gas shale at least, and in Canada, have decades worth of stay flat inventory. They're practicing effectively low to no growth, especially at the current natural gas price and gas strip. And they're returning that free cash flow back to shareholders in the form of buybacks. And it's also just a much easier thesis to get behind. When we talk about oil, we've got to worry about the impact of tariffs on demand. We've got to worry about, pivot seemingly in OPEC thinking and policy. We can debate, the trajectory of U.S. shale growth. We've got other countries adding volumes this year. So it's just become very complicated and very, very volatile. Where the natural gas thesis is much simpler to wrap your head around. Natural gas has gone from a bridge fuel to the fuel of the future. We've seen expectations where U.S. power consumption is expected to grow by 25% between now and 2040. A lot of that is coming from data centers and EI and just general electrification, requiring power sources of 24/7 uninterruptible. And when you look at the quantum of that increase in power, it has to come from gas. It can't come from solar and wind. Just you'd have to build out 5 million acres of solar panels or 115,000 wind turbines. It's just not practical. Nuclear should be the solution, but again, the build cycle is measured in decades. And so Elon Musk did an interview earlier this week saying that we could be running out of power in the United States by mid-2026. And so there's a desperate need for near-term power solutions, and it's going to be natural gas. And it's also a much cleaner fuel than many of the alternatives, especially coal. So the investment thesis is a lot more bulletproof. We can have a lot more conviction in it over the short to medium term. When it comes to oil, it is a little uncomfortable being bearish. We are consensus. That is the consensus call. There's two areas where we see where we could be wrong in that. One is geopolitics, and it's very difficult to have geopolitics involved in your commodity view because you can't call what Trump is going to do or Netanyahu, whether they're going to strike the nuclear facilities in Iran, et cetera, and the Strait of Hormuz and all that narrative. And so you just can't build that into your investment thesis. The other is, will the headline return of OPEC barrels at an accelerated rate actually match reality? And I think it really comes down to Saudi Arabia. They are in the driver's seat today, and especially going forward with the Twilight of Shale, and as that becomes more and more of a reality to the world, will they actually go ahead and add the barrels that they're allowed to? And so we'll be watching export data out of Saudi to try to triangulate our view on that. We look forward to the day of allocating more capital towards oil. We see very, very, very attractive long-term opportunities, especially in the Canadian oil sands. It's just in the short term, we're more bullish on natural gas. And so that's about a 14-minute overview in terms of why we're positioned the way in which we are. We remain bullish in the outlook for energy stocks. We retain flexibility, as we've always been in the past, to look for and try to discover overlooked opportunities. Maybe that's going into the mid caps, which remain out of favor both in Canada and the United States. And so for now, we're quite comfortable with how we have our investors' capital allocated. And so appreciate your time, and we look forward to next week's update with you.